Good evening, TheoTrade. This is Corey Rosenblum bringing you your Theo nightly video for October 23rd, 2018. We're going to talk updated levels, especially after some major earnings hits and misses have taken place. We'll look first at the S&P futures, talk about favorites like Apple, Netflix, Amazon, also Caterpillar, Boeing, and some other key names, McDonald's especially, given what just happened with it. We'll focus on implied volatility, key price levels. It's the most important thing not to predict, but to note levels of turning points, inflections. And if you're looking to sell premium, this video might be for you because we're talking levels that price should not go, or at least should stay within predefined ranges. We'll take a look at all these ranges, levels, high lows, updates from the sell-off, all of it in terms of probability. All right, starting with the S&P futures. Our market bounced strongly off of 2,700 today. We have Don's gravity spots, roughly 2681. We also have 2731 and 2811. There's a lot on this chart, I know, but mainly looking at 2700 as a roundy and key spots beneath it. So roughly 2730, 2700, 2800. Those are wide ranges, sure, but that's where the market volatility, implied volatility, is about 23%. We can take a look at the implied volatility itself or jump inside the near-term option, a few days to go, and look at that implied volatility. The benefit of looking inside the trade tab in thinkorswim is that we get those exact values of the expected price movement. Probability, or at least implied volatility, little percentage terms might not mean as much as point terms. That's also why we like to look at the probability of expiring cone. That's what the purple thing is in the charts that we'll take a look at. It's a 1 standard deviation of the price cone of our probability of expiring. That just gives us a framework of both percentage and, I think more importantly to us as traders, price. Now, let's take a look first at McDonald's. We'll ignore our expected move for the moment because McDonald's had an earnings boost, an earnings breakout on an otherwise bearish day today. Notice that McDonald's had a trading range of just above 170 per share and about 155. That's been the case for the bulk of 2018, with the exception of a couple of spots out in June and October. McDonald's, famous little hamburger restaurant place, is now up to new 2018 highs. The stock market isn't anywhere near there at the moment, so McDonald's is something to watch into the future, and its expected move and implied volatility are a little bit decreasing because that was a bullish breakout. Watch your key spots, which is just under 178 per share, and if McDonald's gets above that, that opens up the continuity thesis, and all of those things happened at the later part of 2017. We'll take a look at the weekly chart to see how that played out, and this sort of stuff, right? This right here, persistent, non-stopping, uptrending price action on the short term and the intermediate term. Look at 2017. So 2018 is a consolidation of that, but now McDonald's is pushing back to the high. And we will have bullish trades if you're willing to trade a Dow component breaking to new highs. We'll now take a look at Caterpillar. Caterpillar had a miss on its earnings, and that gapped the stock. Big Dow component as well, lower. So we did have, like McDonald's, the opposite event happen. Trading ranges, highs and lows at about 158 per share and 134 per share. These are levels that Caterpillar has traded between for the bulk of 2018, but unlike McDonald's, Caterpillar broke to the downside. Now our implied volatility and the probability of expiring cone are both at new levels. Caterpillar is down at new 2018 lows, and we have to go to our weekly chart to see how large or how much this damage of this recent 3-week sell swing and gap today has decimated these shares. So we also had a strong 2017, flat 2018, and now new multi-month lows for Caterpillar. There isn't a lot to guide our decisions, so we do look to short-term plays, short-term levels, and just the acceptance of this breakout from a lengthy trading range. Other stocks we can take a look at include Amazon. So Amazon is still within our EMA compression zone. What's that? It's the spot between the 20-day moving average and the 200-day moving average, roughly 1660 and just shy of about 1830 per share. We're between those levels and expecting a breakout, but we aren't going to pick a direction. So looking at the probability of expiring and our higher, roughly 45% implied volatility, that gives a lot of options for distant put or call sells, or even some iron condors, given the volatility profile and that high volatility leads to lower volatility. That does favor put and call sellers, or sellers of premium. That's what these levels are going to be for tonight's video. Thoughts and ideas as we dig deeper into trade grids for the next month, 2 months, or even into January of 2019. Similarly, Apple is at a critical spot for us. It is the 217 per share level. It's been a multi-month, multi-week pivot, and we're back into it now. Today's session was bullish, low to high, and we are back inside of a short-term trading range. Look for Apple shares to break out of this range for your next swing trade or series of trades. If you're going to sell premium on Apple, note that it does have an uptrend, an upsloping price, but we do have our probability of expiring, 1 standard deviation, at the key levels going into November and December. So that's going to be a key play to watch in the future. Good friend Netflix is kind of a surprising stock for us, given that it hit the expected move exactly. Netflix is a good example of why we use this implied volatility expected movement even through earnings. We talked about this in a prior video, that the expected move for Netflix was about $35. That put us to 380. I put these arrows here in live charting, and that's exactly where we opened and traded away from. So that's the concept I really want to leave you with, is this range, levels, trend lines, spots, markers, maybe even moving averages. We can sell premium beneath that, hedged with spread, or above 420 per share, maybe even 382, 385. And you can look at how distant that 1 standard deviation of the probability of expiring. We can also look at our trade grid as we go through, and taking a look at short-term implied volatility, price movement, and month-based options expirations. So main point of view, if Netflix stays within this trading range as it has done, it could favor distant premium sellers. And that is not making a directional forecast or play. It's just saying, Netflix, don't go beyond these levels by this certain time. That's how I like to see distant premium sells, put call spreads, and the like. It's not so much saying, you must do this. It's, you must not do this by this certain point. And we also have explicit probabilities, at the moment at least, for those happening. We'll leave you with that. Be safe, be careful, note these levels. If you're swing trading, we get some more directional plays from level to level, spot, spot, marker, marker. And again, we frame trades in terms of movement from something to something. And we can also do that through multiple stocks like Apple, from something up away from it. If it breaks, down toward something. So whatever you do in your trading strategies, selling premium, buying premium with a hedge call or put strategy, or just trading individual equities, note your levels, trade the departures from key spots. Take care. This is Corey Rosenblum with your Theo Nightly video for October 23rd, 2018.